Hey everybody, welcome into Mining Stock Daily, reporting from London this week with the London Metals Exchange Week activities. So I'll be running around town throughout the week and getting a number of interviews from new friends, new faces, new voices here for the podcast. And we're going to start out the week. I'm sitting in the office of Hannam Partners and Director Jay Ashfield. Jay Ashfield produces a really great email thread here, I think every day or every week, called the Natural Resources Daily Download. I reached out to Jay a couple weeks ago to see if we could find some time, and I know, Jay, you're really busy, so thank you so much for giving us some of your time.
Glad to be here. Thanks, Trevor.
As you can tell, he's not necessarily British, as the voice can tell, but give us a little bit of background, Jay, about your experience and your career.
Sure. Thanks. I joined Hannam Partners about 6 years ago. Hannam Partners is a just over 10-year-old firm, started by Ian Hannam, who was head of capital markets globally at JP Morgan. Started as an advisory boutique. We've since grown to kind of a full-service investment bank, as most people see it, without the trading side, or the nomad function, which many people do have in London. So really focus on two main sectors within the natural resources space, so mining and energy. We also do have a FIG group as well, which kind of complements us. And it is very much full service. So we have the kind of M&A advisory core, have a big research function, capital raising, etc. But also get involved, across not what is traditionally in the capital raising space. So we do, very active in the debt side, the structured, private, public, etc. And also what sets us apart within the London market in particular is we don't just focus on London listed stocks. So I would say the majority of our names and what we're active in is outside of London. As we know from the natural resources space, a listing is a very minor part of the story. So, where the asset is, where the management teams are, is what we chase, and what we chase, quality assets and individuals.
So was Mr. Hannam's kind of foresight when starting this company was to really stick with resources, and what was that vision that he had 10 years ago? Yeah,
very much so. And if you look at his career of success is very much on, helping start and build up and grow natural resources companies. A lot of them either from, the emerging markets, in particular South Africa, some of the Kazakhstan and other jurisdictions. I think the last trade he did when leaving JP Morgan was merging Xstrata and Glencore. So there's a big natural resources ingrained in who we are and what we are. I think Ian has always had the self-titled king of mining. He wants to continue that. I think our place in the mining space, the natural resources world is pretty strong. We're very much a go-to shop when coming through London.
Yeah. Well, talk about the timing of the foundation of Hannam and Partners. If it was 2013 when this company's really formed and getting its feet on the ground, that was kind of coming off of that big commodities bull run, obviously. I mean, was that the timing that, at least this business would be in the position when the next cycle really finds its feet again?
Yeah, absolutely. But also if you look at, how it was started, was very much on the advisory principles, not necessarily on tapping the capital markets. Mm-hmm. The capital market side and more capital raising and broking bit came really around when I joined and the head of research joined here. So if you coincide that with, slightly stronger equity markets, but, as we know in mining, it's highly cyclical. Not a lot of capital had gone into the market during the first 6-7 years of the firm starting, but we were very successful in terms of bringing strategics in to certain companies, or on the merger side, or on various other strategic elements. So it was almost not dependent on what cycle we were in.
So what was the company advising companies with or on?
Yeah. So a number of things, and we can kind of go through a few kind of highlight transactions of the firm, but one in particular was largely or a very financially distressed company called Kenmare Resources at the time. They were strangled by a shareholder. They were strangled by a potential M&A bidder. Who, which because the UK takeover rules or Irish takeover rules weren't able to raise capital or say anything that they could really, expand on the business. And, they were down to a £30 million market cap. There was, almost $2 billion spent on the asset. And, there's a, $200-300 million essentially rights issue and restructuring of the debt in which we brought a sovereign wealth fund in to backstop that. So that's the sort of thing that you needed to get a bit creative.
Okay. And so now that the business strategy has evolved, you're more into the capital markets and raising of capital for these companies. Talk about the ethos of like where you kind of came in that role that you brought and kind of evolutionized here at Hannam Partners.
Yeah, but also I would say that everything that we do does have a sort of strategic element to it. Mm-hmm. That's the way the capital markets are feeling and doing at the moment. And depends on how you classify strategic as well. So right. Whether it be the pools of capital from private equity which have come through, or the kind of what everybody believes is the strategic from a big company or sovereign wealth fund, et cetera. So most of the transactions which have been achieved in the UK capital markets or indeed by ourselves in other areas has some element of a strategic around doing a normal equity placing. So for example, if we're going to the market for a big construction financing, you're not going to do it just by kind of calling up your local broker and saying, I want to raise $200 million right. to raise for construction financing. So we always try to kind of piece everything together, bring it all to the table before kind of getting that last little slice from the equity market.
It sounds like H&P is really, the catalyst that you offer is really the strength of the network, right? Not only from resource company, whatever cycle of the mine life that company's in, but also the network of people who might be looking for exposure to the mining sector that have the capital to actually take important large positions in whatever stage of life that is. Is that fair to say?
Yeah, absolutely. And the sort of companies which we deal with as well is pretty wide ranging. We like to also back early stage companies or management teams which you've worked with before, or a number of other something that we have a really positive take on an asset or a commodity or a jurisdiction, and help them work through that evolution. Yeah. So there's a couple of examples where we've been there right from the beginning, and now we're into more kind of more the strategic review side of things because almost taking them full cycle.
There's in the last couple of years, obviously it's not been a great market, but there have been stories out there where projects have been able to get funded and have been built and constructed and are now producing. And a lot of times it has come from creative, maybe unique approaches to financing that construction, right? Yeah. Was that kind of out of necessity because, maybe 5 years ago, like the traditional going to the banks and doing this mix of equity and debt to get your project built and constructed just wasn't present, so companies had to maybe work with the likes of H&P to find creative ways to get that capital in that, the market had maybe never witnessed or seen before?
Yeah, I think it's a completely changing universe of funders, whether it be from the traditional, French and Australian banks who mm-hmm. used to be the big go-to project financiers, even the big institutions in London or from afar aren't as flexible in terms of their capital and how they're investing. So, there's emerging pools of capital and destinations, which require a bit of structuring and clever footwork to get things through. Obviously, the private equity side has more emerged in terms of the pools of the capital, in terms of the depth, in terms of the structure, which again is building on what was traditionally used quite effectively in the precious metal space and the royalties and the streamers. So the pools of capital to really deliver projects and get the funding that's needed has evolved. Obviously, seeing a lot more changes in that, with whether it be OEMs or more government-backed entities getting involved in the space. And again, it's more jurisdictional. It is sometimes a bit slower and only for the right projects and obviously right commodities. Yeah. But things are continuously evolving.
What is the current status of private equity in the mining industry? It's felt like for a while there was very concentrated to just a handful of companies. But has that has it been kind of loosened up over the last couple of years at all?
There's definitely new names in the universe.
Okay.
Some of the old hands, let's say, have just had to become a bit more flexible in terms of almost on a deal per deal basis, rather than here's a very large pool of capital and they will invest in a dozen sort of investments. It might be now on a kind of one deal. We have these LPs and we'll go on that. But yeah, there's definitely new pools. There's definitely other sovereign wealth funds creating their own pools of private equity.
This is interesting. Can you expand on that a little bit, because we've never actually talked about sovereign wealth funds on the podcast, and especially when it comes to mining, because my hunch is always, at least in this this era of ESG. That sovereign wealth funds, for the large part, were off the table as being, resources of capital. Maybe I'm wrong to have that to think that way, but
yeah, a lot of the sovereign wealth funds are more fund of fund type investors, but we've seen, particularly with the PIF in Saudi, being quite direct in some of their investments, whether it be working with Robert Friedland's Ivanhoe Electric, doing joint venture deals with Mod and other sort of companies and direct asset deals, rather than just putting $1 billion to work with another large private equity fund where they don't really have that much control. So they are starting to get a bit more flexible and direct. I guess one of the examples there. And some of them, whether it be, the Omanis or Qataris or Chinese or Singaporean, they it's probably a bit more not quite full in, like we're seeing from the PIF.
Okay, interesting. Yeah, Saudi Arabia mining and exploration is this absolutely fascinating story. But I'm wondering, if with the last few years, have you seen, with this era of ESG, have you seen funds having to remove themselves from resource investing? And if so, or if not, but if so, have you seen a new groups kind of fill those shoes that others kind of walked away from?
Yeah, I think for quite a long period, a lot of the mining private equity groups in particular have never been able to do coal or certain carbon intensive investments. Now, I don't think we've seen anybody kind of new really backing off from that. Church of England has been very vocal of even some of their more significant direct investments, but I wouldn't say they're necessarily a mover and a shaker in terms of the kind of driver of ESG within mining companies, or certainly pulling big investment back.
Yeah.
But I think the whole ESG movement has put more emphasis on the kind of critical minerals and the battery mineral investments. If you look down the list of some of these minor metals, they're probably getting almost an over allocation in terms of the private equity world, where it is minor for a reason in terms of the total supply, and obviously demand side looks to be growing, but needs to have that investment.
So are they? So let me just clarify, because so you think there's more capital being allocated to things such as critical minerals, that maybe it's overdone?
Well, not necessarily overdone at the moment, because we haven't really seen a big uptake in supply. We haven't seen any mines being produced.
Right.
It's now down to the junior mining companies to either make a success or failure of the capital and building of these projects with the increase of capital. But if you look at a small market like a manganese or these sort of minor metals which are riding the bigger, or graphite is another good example, where a lot of capital has been focused from the investor universe, private equity, etc. From such a low base, the demand really has to come in to fulfill this whole kind of supply-demand balance.
What about when we talk about copper? This has always been really interesting, because for 2 years, all during COVID, we were kind of spoon-fed that supply-demand curve of copper, and I remember Goldman Sachs putting $14,000 a ton on copper, and it hasn't panned out quite yet. In fact, we're seeing a lot of headway in base metal prices because of this environment of higher yields, fear of global recession, just lack of demand from the consumer, global consumer here. I guess how is H&P kind of wading these waters here of the unknown, of a new regime, a new financial regime of higher rates and a slowing global demand when it comes to advising and working with these mining companies? How is that really how's that changed in the last 6 months?
Yeah, I mean, in a way, it hasn't changed in the last 6 months. We as a house obviously take a long-term view on the commodity cycle.
Right.
We too are a believer at the back end of this decade. I don't think we were ever really necessarily pushing copper stories because 2023, 24 will be good years. It's back the commodity cycle.
Mm-hmm.
One at a time, but also the capital needs to go in at certain times, because it takes a hell of a long time to go from discovery to all the feasibility study work, the permitting, the building, and then to actually come into production. So when a lot of these companies are now forecast to come into production is the back end of this decade, where there is that strong supply deficit, which we still think it's kind of on track for, if not now exasperated because of what's happening at the moment.
But if there's a number of projects that look to come online later in the decade, is there equilibrium there in the supply demand, or is it oversupplied?
Well, no, at the moment, none of these projects are being funded. So that's the issue.
Yeah.
So a number of companies, great assets, they might be listed or not, going through the feasibility study work, needing to progress. But the sticking factor at the moment is the lack of capital going through these. So the demand side is still very much there and looking quite strong in, kind of 3 year plus, 2-3 year plus. But the problem is these projects aren't advancing fast enough. The capital's not going into the ground because of the weaker capital markets outlook.
Mm-hmm.
So the weaker the copper goes in the near term, the more dramatic the back end will look like.
Have you seen something like this play out before? Have you been in these shoes before?
I mean, the capital cycle has been pretty abundant in mining for a while. So, I mean, I've been in the space since 2005,
Mm-hmm.
6 side. So, seen quite a few cycles since then, and it's in almost every commodity. After the late 2000s, we saw a very supply constraint, capital constraint, which then did benefit for the kind of few years beyond that. At the moment, it is not a lot of capital has gone in, apart from the last kind of couple of years, but not many discoveries. It takes, I think it was a study, a couple months ago, takes 15 years on average in the mining space to bring something from discovery into production.
That's pretty fast, because I think I saw 25 years. So
Yeah.
I mean, there's a spread there, right?
There's a spread, but then look how many cycles have happened in the last between 15 and 25 years.
Yeah. So in previous cycles, people have said this is like 2018, but worse, maybe because sentiment is so poor right now, worse than it was 5 years ago. But it seemed like it was just like a flip of a switch, and all of a sudden, some money was coming back, flowing into these resource markets, and I've not necessarily seen that. Maybe, I don't know. We can talk about what's going on in the Middle East here in just a minute, and I do want to talk about it, but I don't want to kind of jump into it yet. But I do want to kind of get your sense of, is it going to take something just like a higher metals price to get capital flowing? I mean, when's that light bulb of intrigue going to come back from generalist funds and also retail money to start putting money to work in this sector?
Yeah, I think it's the issues are beyond just the sector. We've seen liquidity being zapped out of the system, for a while now. If you look at global yields, it doesn't make for an easy equity environment. What will it take for capital to flow back into mining? I mean, we'll see how long the I guess weakness continues, but there's also positives within the weakness, as we've seen with every cycle prior to this. So look at uranium at the moment.
Yeah.
On the lithium side, obviously pricing has come down, but the corporate activity has been very strong. So there's pockets of positivity within it, and I guess for the institutions and the retail who might not be as actively involved, sometimes it just takes a big M&A deal, or sometimes it takes a couple of quick wins to really get back the juice in their minds, that they can further make more money in the space.
Yeah. Oh, and the gold M&A deal, that Newmont Newcrest acquisition, it's kind of like feathered out here. Like there wasn't as much. The excitement was for about 48 hours, and then just kind of petered away.
Yeah, I mean that's a problem with largely share transactions.
Yeah.
People will just be stuck in the new entity, or again, if they're large shareholders of both of them, they can't be, increasing that exposure. But also, if you look at big M&A in the gold space, or big M&A in general, how much value creation is there actually? Maybe in the smaller end, when there's two single asset producers getting together, then you might actually see some strong value creation. You might see a lower cost of capital. You might see actual shareholder changes and cash being flown around. Where in big gold M&A, I just can't see it.
Okay, interesting.
But on the back of that, you might see 4 or 5 new companies being born out of a Newcrest Newmont merger. So that's what we basically have to wait for.
I actually think you're spot on with that one, because there's things culturally between the two companies that just don't quite align. Newcrest was obviously very active in creating these JVs and taking strategic positions with exploration companies. Newmont, a little bit, at least in the back of Nevada Gold Mines, their partnership with Barrick, you saw more of that. But you very rarely saw Newmont taking, 10% positions in exploration companies, where Newcrest was doing that quite frequently.
Yeah.
So if these companies actually, if we get an announcement where this deal is done and those two become one, I'm wondering, what happens with that Newcrest money as a Newmont with these small exploration companies? Do they get to keep depending on Newmont for that exploration capital, or is that going to dry up? But also, with some of those, can you kind of spin those out, those non-core assets, as a larger Newmont into something else, new vehicles?
Yeah, I think we'll get a combination. I think, they might have had some preliminary discussions in terms of their internal, what will we do with this? What is our strategy? Where do we want to focus the kind of low-hanging fruit, as they say, within the first 100 days of being a merge co? What do they want to achieve? Where are the jurisdictions where there wasn't any overlap? Do we want to be in Ecuador? Obviously, Newcrest has a big position there.
Right.
What do they do with other kind of Australian JVs? There's a number of what do they do in Africa? There's a number of avenues in which it could go either way. I think it's too early to tell based on I guess where the deal is before saying definitively this is the way they're likely to go. This is the opportunity set to go after.
What are some of these incoming phone calls? And I know you can't get specific, but it may be a general theme. In the last 6 months, what are some of the phone calls you've been receiving as far as how to advise these companies in this really tough market?
Yeah, I mean there's a fair bit of I guess phone calls and saying, I'm in this, should I be in this? It's a lot of protectionism within the portfolio of, I see capital issuances across, many of my portfolio, is there a likely chance of this happening here, or should I be doing this, or so it's on the defense in some aspects. It's kind of getting on the front foot of other aspects of this company will be doing this, that, and the other. They're well cashed up. So it's looking at opportunities, but also how can I kind of protect my portfolio?
Yeah. Okay, let's talk about really the elephant in the global room right now, and that's been the events happening in Israel and in Gaza over the weekend. We were in preparation for this discussion. Obviously I wasn't prepared to talk about implications on resources based on basically a war happening in Israel, but here we are, and so it's about lunchtime here in London. We've seen gold shoot up about $25. Oil has shot up, I think, $4 the last I saw. I think that it was expected, given news out of the weekend. You don't want to see resource prices jump on geopolitical fear, because we know what happens afterwards. They always retreat and come back. But this has ramifications for not only precious metals and energy, but also I would think would have ramifications with just base metal prices as well. And so I'm sure you were kind of spinning your head over the last 24 hours and thinking about how this plays out with the metals market. So I guess what are some of your thoughts here, given what we know and what we've seen the early price moves this morning?
Yeah, I mean it's very much more of a geopolitical issue, vis-a-vis the Russia-Ukraine.
Yeah.
So you're not going to have bigger supply disruptions and issues from that, apart from more on the energy space. So natural gas was up pretty strongly as well. So it is very much in the first wave. The gold, the oil, the natural gas in terms of the price movements. And I think gold is still being held back by very strong rates in the U.S., stronger dollar. So it would certainly be a lot higher if the dollar wasn't as strong, in particular. And it really depends on what now neighboring and foreign governments, superpowers do in response to this, and how long it will drag on, in terms of what will it mean for global growth. What will it mean for, general macro supportive measures in the base metal space? You can't really say it's going to change the path to China and how they're going to be buying for continuously building their EV balance out, or hopefully further stimulus in due course to really get their economy going. But certainly it does have the potential disruptor factor for just what the global GDP will be, because military spend or what have you will have to take away from.
But I'm thinking about this in lines of neighboring countries and involvement, and there was like these news headlines that a better partnership between the Israelis and the Saudis looked like it might be heading that way and would be a big win for President Biden. I don't know if that's still on the table now. Obviously, Hamas's relationship with Iran, those pressures are heightened extremely high in the last 48 hours.
Yeah.
But even beyond that, if the border into Gaza is being blocked by the Israelis, the next way of getting supplies into Gaza is through Egypt. So what does that relationship with Egypt in the West look like now? I mean, it's all unfolding, right?
It is, yeah, and it's too early to tell based on, I guess responses from, or lack of from, U.S. government or other neighboring countries. I mean, I'm sure we'll have a few headlines just from this meeting of what's been happening. But it'll be I think just the start, really.
It's just part of a bigger geopolitical cycle. I mean, issues in Ukraine have been going on for a year and a half, 2 years now. It seems like, at least from the West perspective, support for American resources to Ukraine publicly is waning. I think that's fair to say. But here we have another escalation in one of the largest partners of the United States and Canada's that we will undoubtedly support. And we're moving we're moving aircraft carriers into the region.
Yeah.
This is just, I guess Israeli Gaza wasn't on my bingo card, but at least for 2023.
Yeah.
But do you feel like this is all part of like a general geopolitical cycle that
potentially it's been quiet for a while? I hope not, but
right.
There's also happenings in between China and Taiwan. So you hope there isn't a further escalation or cycle of big geopolitical issues, but time will tell.
Yeah. Great conversation. Great to meet you. Let the listeners know about your email and how to reach out, because it is like very thorough.
Yeah.
And there's a lot of great information in there, and I think it's worthy of everybody to like subscribe to.
No, thanks, appreciate it. It's free to anyone. Direct you to the Hannam Partners webpage, which is just hannam.partners, and you can sign up or reach out to me on that.
Okay. Jess J. Ashfield, Director here at Hannam Partners. Thanks so much for your hospitality.
Thanks, Trevor.
The information presented should not be considered investment advice. Mining Stock Daily and its affiliates are not responsible for any loss arising from any investment decision in connection with the material presented herein. Please do your own research or speak with a licensed financial representative before making any investment decisions.